Here at Longin's Capital, we've spent over a decade building a strong track record with our full suite of services and high performing funds. Now we're setting our sights on something even bigger, an IPO in November 2027. It's been a long time coming, and we are ready for the journey. Join us in our next big step. Visit our website to learn more. Hi, I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, founding CEO at Lundgren's Capital.
This is Sound Economies with Mel and Peter, a weekly East meets West podcast by Lundin's Investor Insights. Join us as we dissect the biggest and most interesting news on economies, financial markets, and central banks globally. Welcome to the show. Hi, Peter. Happy November. And what's been keeping you busy this week?
Hi Mel, yeah, happy November. This week I'm actually a few days in Berlin, the German
Mm-hmm.
capital. Actually, Lundgren's Capital is invited to participate in two leading, or the two leading German climate conferences. Actually, Green Tech conferences, whatever we call them,
Mm-hmm.
it is climate. And that is extremely interesting to join in every time. Two individual days. This year it's a bit even a bit more interesting because a big guy within the industry, Bill Gates, yeah,
Yes.
he announced for a few days ago he's changing his position about how to consider climate catastrophes, climate changes, and so. So that is sort of adding a bit more spice.
Mm-hmm.
And we, as Long Queens, we are deeply involved in actually in green tech, clean tech companies. Yeah, well, what are you up to this week?
Yes, Peter. So actually, we are in the middle of preparations for our next few magazines. So that's coming up soon. We
Mm,
are very recently focusing on the Asian markets, the ASEAN and
mm,
China particularly, and we're seeing quite a lot of interesting developments. One of which we'll discuss in a bit. Um, Particularly, we did mention last time about China's next 5-year plan for their economy. So that's one of the things we're really watching out for as far as details, because of course, as the plenum ended in October, we saw broad strokes, and
mm,
little by little, we're seeing more details, and that's what's keeping us excited, apart from the usual monitoring that we do as far as markets are concerned. So yeah,
Good.
speaking of markets, we have a widely varied and equally interesting lineup of topics for this episode. First, we'll stay over here in Asia to look at India and their rollout of tax cuts. So they've done two major tax cuts this year. Let's see where it is and how far it has gotten them. Then we'll cross over to where you are in Germany, an outlook for family businesses, which is really a big part of the German economy. And then we'll take a step back and look at emerging market stocks, which have rallied for the best performance since 1993. So
Mhm.
quite a milestone there. And
Yeah.
then we'll go back to the discussion about Bill Gates' change of heart, it seems, towards climate change.
Yeah.
And yeah, more on that. And of course, we end with our global outlook.
Yeah. Exciting, Mel.
I'll
Exciting.
head over to India, Peter. So,
Yes.
a few months ago, we talked about India's one of two tax cuts. So, initially in February, they adjusted downward their income tax cut rates for most of income earners. So, these salary people, salary men, salary women are getting more from their take home pay. That was an attempt to perk up GDP growth by consumption, because 7% wasn't too good for them. They want to keep it at around 8, but dipping at 6 percent wasn't too good for them. That would be a dream for many other economies, but not for India. They want to grow really fast, really soon. So that was the goal. And then came Trump. We did also discuss how essentially now they are suffering the biggest tariff for their exports. So now they're at 50%, all because they didn't want to stop importing oil from Russia. So they're being punished by Trump for that. And that's begun in about September. So the response of the Indian government is to cut taxes another time. This time, the goods and services tax. They're cutting it down from a high of 28% to 18%. The lowest rate remains 5%. So that is expected to unlock some $68 billion in personal or household consumption into directly into the people's pockets. So far, it's been about 2 months since that was rolled out. Perfectly timed ahead of the Diwali holidays in India. So
mm,
consumption
mm,
has been up 8.5% across all types of goods, jewelry, clothes, gadgets, cars, even. So far, so good.
mm,
But at the same time, it could all just be pent up demand. So the longevity of this policy, as far as lifting GDP growth is concerned, we'll still have to
mm,
wait and see. But I
mm.
think it's healthy to point out that this is a one-time option. Since they did this in one go, two in one year,
Yeah.
if it turns out that it wasn't really such a huge offsetting factor to an export slowdown, they would be limited in terms of more choices to how else they could perk up domestic growth. And add the fact that a lot of the Indian economy is informal. So as far as taxation is concerned, they're not really targeted by these types of tax cuts. And also, another factor that they need to consider is, of course, they need to manage debt and the budget deficit because when you reduce
Mm,
taxes, government gets less and less. And
mm,
for a developing economy like India with really a lot of mouths to support and feed,
mm,
it could be tricky, especially when debt is hovering around 80% of GDP. So
mm,
that's something they really need to balance. I do remember that their president isn't really as hopeful or open to negotiations with Trump anymore. So yeah,
mm.
if this will hold, maybe they could have this as a leverage. Otherwise, they will have to be more creative in offsetting that Trump effect, Peter.
Yeah, but it is interesting that we have seen a number of emerging market countries lowering tax sort of across the board. It can be income tax, it can be corporate tax, it can be different consumption taxes, whatever.
Yes.
Yeah, and we are, I would say, probably seeing it increasingly
Mm-hmm.
uh, used as a tool to boost the economy, free up the economy, depends on how you see it. Simply to make the economy moving and lower the tax burdens. Now,
Yes.
it can be significant because there are a number of countries they have a huge difficulty doing the same, and these countries is what we call the old economies. So high cost base and so big public spending that it requires major reforms here to do the same. Which economies for the next 10 years will be the winners? It will be the economies that are flexible. Static economies, they will go lower, down, and the flexible economies, they have all the chances to participate in an ever-growing world, ever-changing, and a world with truckloads of new opportunities every day.
Mm-hmm.
This is how we see the world. It's always a game, as you say. India has a debt level of 80.
Yes.
Nowadays, that is almost seems a bit low, yeah. But for an emerging market economy, that needs to protect its currency reserve, everything needs to be and ensure investors that everything is good. A debt level is a bit more critical.
Mm-hmm.
Secondly, this India has also a particular situation because it has a what we would call a positive demographic development or curve, means where truckloads of countries explore a growing elderly generation. Then we have the demographic curve is looking as a natural, so to say,
Yes.
that the young generations are the biggest generations in India. So
Mm-hmm.
there's a big and ongoing flow into the labor market.
Workforce. Yes.
So India actually needs a very high GDP growth to keep the GDP per capita at the current level. Otherwise, there will be a individual sort of setback. Yeah. So this is a part of what also the challenge that India has,
Mm-hmm.
so to say. But still, it's a strong flexibility sign.
Yeah.
We would argue if it managed well, some of these tools that brings the Indian economy, yeah,
Yeah.
fantastic, interesting
Mm-hmm.
and it is after all one of the as a larger economies in the world, not only
Yes.
measured on people but also in absolute size. So
Mm-hmm.
it is significant. We should notice. Exciting.
So that's actually a very bold move to I think
Mm.
they're the one of the bigger economies that is attempting to stay away, like not really negotiate a lower tariff rate from Trump. And maybe if they pull this off, other countries would reconsider as well their negotiations. But of course, it is a different tack that they're taking, Peter. So something to watch out for again. Meanwhile, Peter, let's head over to Germany. We are seeing a new survey about family businesses and their business plans.
Yeah, it is. It's some you would say very domestic news, very domestic research. But it is extremely important for investors to notice. It is the Business Association for Family-Owned Businesses and Young Companies.
Mm-hmm.
Now that sounds a bit sort of grocery store, uncle grocery store like businesses in Europe's biggest economy, yeah. But it's not. This includes huge, as we are talking about, a huge number of family-owned businesses, and family-owned businesses in Germany is actually the backbone of the economy. And some of these companies are global players, also they are very big names.
Yes.
Some of them we would know, and they are still family-owned. So it is certainly not just sort of
Mom and
Uncle
pop.
Uncle Joe having a sort of a small shop. Yeah, this
Mm-hmm.
is this is significant. Now, the survey that has just come out from the Business Association says that 23% of all these businesses they consider to lay off jobs this year, this quarter. This
Yeah.
is serious.
Yes.
Of course, it's natural for each and every company towards year-end to consider, okay, so where do we fine-tune? There's a budget process. How can we cut costs? Do we need to fire sort of another 3-5% or adjust the labor force? Whatever. That is a natural considerations. Also, of course, on the growth side. So how many people should we hire next year? That's absolutely okay. But 23% is a lot, and it's actually up from 19% at the same time last year. It comes fine in line with another survey taken by
Mm-hmm.
Economic Institute based in Cologne in Germany. That is actually pointing at 36% of all companies consider to cut jobs
Maybe
next
even
year.
higher. Yeah.
Yeah, the other side that is also important to ask. So how many companies are considering to hire? In that second research here I refer to, is only 18%. So we are seeing this pressure mounting on the German economy, and the family businesses. They have a twist towards being industrial companies. But we should
Mm-hmm.
consider it's typical companies that hold as long as they can on their good workers. They don't want to lay them off. They feel responsibility for these people. So 23% is a high number, and
Yes.
this will continue into the new year, also due to this survey. and even bigger number are as also a rising number say they do not invest more.
Mm-hmm.
So there is no capex impulse into the
No.
economy from this huge, and it's a huge sector across Germany. Now, these are the numbers that nobody sees. Because first of all, it is, as mentioned, a very domestic sort of survey. I don't think it will reach any English-speaking newswire or wherever. It can be that the Financial Times Germany sort of section they take it or whatever. But the financial markets react on the big numbers, the big headlines, like
The macro.
when
Yeah.
yeah, when the new government got the spending packages for infrastructure and for defense approved, okay, it cheers up investors, particularly, of course, in the stock market. But these numbers here, they are not seen, they are not taken into to consideration in the financial markets, but investors should be aware of them. And let's be honest, there's a small hope, as there is a hope of a small uptick, that is the way to say it, in the German economy. And these are one of the forces that will let the hope remain a hope. And it will just be a flat experience again. If one look into the latest labor market statistic that was published in Germany, the yearly development in unemployment is rising.
Mm-hmm.
And you say, so why's that? Okay, the economy is a bit sort of flattish. Let's say maybe if we're lucky, it's plus 0.2% in GDP growth, something maybe, if we stay on the positive side. And you say, okay, then you would expect the unemployment to stay sort of fairly flat. No, this is the reason why the unemployment on a yearly basis is rising in Germany because all these small layoffs they accumulate into a bigger move, and it was actually significant for the last month. So this is important, and it is so much in contrast to what we just talked about in India. They're
Yeah.
taking bold tax reduction moves to keep up the speed in the economy. And here in Germany, the government, with the Chancellor Merz in the lead, has promised so many times that this will be the autumn of reforms. And as mentioned, I am physically in Berlin as we record this. It's a beautiful autumn day with 15 degrees, and that is a fine temperature
But
for Berlin at here in early November and the blue sky. But I can confirm that the autumn is here, but the reforms are not here, and it seems they might be postponed to the spring. But it is just to underline one more time, the German economy is just going behind all the time,
Mhm.
and the reform needs are getting extreme big. This is why we say it is hard. It is very hard to point at Germany as an investment destination. We do like it a bit for the non-listed stuff, as a the private
Private
market,
market.
not
Yes.
not listed.
We've always talked about lack of productivity or declining productivity in Germany as well. So,
Yeah,
coupled with high rising unemployment, that's really not a great sign for the German economy, Peter.
not at all. Another development confirming as we see it from our perspective, we get confirmed in our unfortunately pretty negative sort of view. Yeah. But this is how it is, and we
Yep.
need to take it into account as investors.
Yeah, we can compare that trajectory in Germany against emerging markets, Peter. On the other side of the coin, we see emerging market stocks having their best year since uh, over the last 10 months straight, it has been rallying. So the whole emerging markets index of the MSCI, for example, it's up 33% as of end October, year to
Mm,
date. That is easily above the performance of the US index, 17%. Europe is up 29%. World index is up 20%. And it's really one of the many ways we see what we've observed and discussed in recent months how there is an increasing pivot away from the developed world particularly the US. I guess the most telling part of of these numbers is that world index up 20%, emerging market index up 33%. World index is actually 72% US stocks, and that's clearly why
Yeah.
it's faring much lower than the emerging markets index. And really the search for growth, investors who really want better yields, less volatility is really shifting towards other portfolios. And by sector, it kind of looks the same. In both indices, it's IT, financial, so the banks and the financial institutions, and consumer companies. But the distribution is really where it's different. So the emerging market index is mostly a mix of China and Taiwan, 50%, and then India, South Korea, and Brazilian stocks. On the other hand, you have the likes of US, Japan, the UK dominating the world index. And that's clearly
Yeah.
where growth has slowed significantly over the past years. And the more we look at the details about how governments are trying to get things perked up but failing is also a story of why it's not growing as fast as they could. And really, we are not surprised. We've talked about this repeatedly, and recent developments show that really where you should be is where the high growth areas are, and that's in the emerging market space. Um, and I think this story will continue. Recently, we are seeing US stocks on a decline, and we've said that a correction is due for US stocks, and maybe this is the start of that trend. People are increasingly becoming, I think the initial surprise from the AI boom is lifting, and yeah, it's part of the normal now. So they're not so excited about it as they were a few months back, Peter.
Yes, you refer to the movements, and it is again what we will see as a structural change in the
Mm-hmm.
market. The flow into the emerging markets is not just a speculative flow; it is a structural change.
Yes.
And so far, we see it particularly actually out of US, yes, and that's sort of a Trump effect, yeah. Now, and the AI discussion, yes, there's a lot of discussion about the valuation of AI, and that will generate volatility into the market. That is without any doubt.
Mm-hmm.
And we still recommend to, if investors haven't done it, to let's say reconsider the portfolio just to withstand a correction of maybe 15%. And 15% is sort of is the average, yeah. And the
Yes.
most volatile stocks they will swing more. That's natural. And of course, if the market is sort of could correct down 15%, then we could easily see tech stocks, AI stocks, as the most bought stocks, um, showing a bigger swing. It doesn't mean that the long term are wrong to hold, on the contrary, but it's just what could happen. Then what we see for yeah is about to happen, and the emerging markets is a very good alternative.
Mm-hmm.
As the Asian region is the biggest economic region in the world, so why not be exposed? That makes sense. And at the same time, of course, if Wall Street dive 20%, all stock markets will go down. Of course, they will. There's no safe haven against such a Wall Street dive. But still, it could be smoothened out, and there we actually prefer a lot of emerging market stocks still, despite how much they've
Mm-hmm.
gone up this year. Again, sort of compared to, we do not see Europe in general as a place to be. It can only be a valuation question. There's no macro help at least, and so it can only be a valuation question about individual companies when we talk about Europe. Strong performance, and we actually sort of believe in general it will go on.
As we talk about
Um,
rebalancing portfolios, Peter. That was exactly what surprised many, with Bill Gates saying that investments towards climate change initiatives should be reconsidered as well. So quite a stir, I'm sure, from the conferences you're attending.
Yeah, that for sure has added some extraordinary spice, and it is so. Why is Bill Gates interesting? He has a foundation that supports also green initiatives, green investments, and he, after all, has handed out, what do I know, probably 55 billion US dollar the latest decade. Yeah,
Yes.
so the foundation is it's a heavy one. Yeah.
Mm-hmm.
Now, but he is also what you call a capitalist being involved in the climate um, movement. Not only debate, but actually part of the climate
Initiative.
movement somehow.
Yeah.
Yeah. The wording that he's changing is saying, okay, we are not talking about a climate catastrophe anymore. We are talking about that the climate is changing, but leaning much more towards how to deal with the climate change. It is not to counteract it, and that is where the big changes is. So we have a huge fraction saying, okay, we have the climate goals and we have all the agendas from 2030, 2040, 2050, saying we need to scale back the global temperature on levels that we saw before. All this sort of thinking, he is all now relativating a bit and saying, okay, is the global temperature also the right measurement and all these
Mm-hmm.
kind of things. A big fraction within the climate activism, whatever we call it, movement, will see him as a traitor. Also, he is a traitor.
He
There's
abandoned them.
a really big fraction that wants to take the global temperature back to prior
Mm-hmm.
standards. What Bill Gates now is pointing towards or leaning towards, as I see it, is saying, okay, we need to live with the climate change. That requires different initiatives to live with climate change, but not to increase the number of deaths per 100,000 globally. Means that we need to have wells to basically to counteract, to reorganize our life, houses, well, all kind of things. We simply need to earn more money to be able to reorganize ourselves and to live with a higher temperature. That is one thing. And then, of course, there's the trust in innovation. The trust in innovation is a huge discussion as well against the different fractions within the climate debate and movement. So this is basically what he is representing now, and he is a capitalist. We should remember representing. There's no doubt that the whole process has been initiated by the change of the view at the U.S. president level, as a Trump. It's not that U.S. is world famous for being the
A
front runner
champion.
in clean tech and green energy and whatever green, yeah. But they are doing, as paying a lot of money into truckloads of international organizations that is also involved in the climate somehow, all directions. And now this is a big change, of course, that Trump has said we want to have a different look, and it's just to pump up more oil
Mm-hmm.
and then forget the green energy, basically. Now it doesn't mean that the green energy is dead. By no means. It is not what Bill Gates is saying. So I see it in a way that we'll see more focus on more fundamental issues about climate investment, green investment, clean tech investments, whatever. And that is there'll be much more focus on if it's commercial viable. And that is the
Mm-hmm.
only way to get good initiatives and innovations to grow and spread out the world. It is if investors they can earn money. Some investors they are more philanthropic, saying, "Okay, we just like this. It doesn't matter if we get our money back." Now, this is still a small fraction. There will be some investors and also some public funds saying, okay, we are happy if we get a small return. This will still be there, but the big moves needs to be commercial viable. Simply as that. And that will be there'll be more focus on that. I think that will be the biggest change within investments into to green technology. We've seen a lot of funds pulling out. We've seen a lot of projects going bankrupt the past 12 months. A lot of venture capital funds, they've burnt the fingers and they're not in the game anymore,
Yes.
or they're reconsidering. Yeah, so there will be much higher demands to sort of green projects. We are deeply involved at Long Greens
We are,
in
yes.
green stuff. Yeah, we have a particular one cooperation partner where we have alternative investment funds that have funded their first production facilities, and
Mm-hmm.
that is this company is, and we can say it is within the top three in the world within their clean tech segment. It is fantastic. It's fascinating, and they'll be one of the survivors. Now, but the journey is longer than expected, and that is what many investors have observed. It is, but it's moving forward, and we will at some time come up with a new fund, sort of 20 million US dollar size, and we expect it to return like 15% to the investors. And this is things that will work. Right now, we are extremely busy, but we have taken on another green project that is
Okay.
commercially just so good. It looks so good, and we said, okay, we simply need to support it, and it is something that is of very high quality. We would like to show to our investors. These kind of things, they will win. So this is what I expect would is actually changing right now. Bit
That's
more.
what Bill Gates would like.
The economy in the project is getting more focus.
Mm-hmm.
And that also mean a lot of wishful projects, they will have bigger difficulties finding investors. But the healthy ones should move on as we see. So
Mm-hmm.
this is extremely interesting. And green technology is a segment that fits into a lot of portfolios, so it's natural to, it's a big business. So it's natural to have it portfolio. Again, right from the middle of Berlin,
Yes.
that is a discussion points all of a sudden.
Similar to, I guess, the tack that Bill Gates was taking towards climate initiatives, it is similar, I guess, to our long-held view that we like risk, although as well we do want it to be well considered. And we've touched upon our outlook as far as some economies are concerned, like Germany and the general EU area. But we continue to prefer risk. We like to take on risk and we like growth as far as our outlook is concerned. So tides are changing as they always do, but our optimism towards growth economies in Southeast Asia, in China, and emerging markets remain, as well as our view towards preference rather towards private markets in Europe, for example, the unlisted companies, growth companies,
Mhm.
versus the typical listed markets there, Peter.
Yeah, exactly. We remain to see a lot of upside in the world actually, and it's where we hang our hat, so to say. It's we do see it as we recognize the risks and where we are trying to downscale and move a bit away from, to adjust a bit more to also to say okay, there could be a correction of 15% general in all asset classes, but it's not enough to step out actually. It's a good reason to readjust. So yeah, so actually we do see more sunshine than clouds, and yeah, that's basically it. Yeah.
Thank you, Peter, and I hope you enjoy the sunshine in Berlin.
Yeah, it's fantastic. It's great, and yeah, so we'll get a bit more green conversations now after this podcast. Thank you for hosting, Mel, and thank you to the audience, of course, for listening.
Thanks for tuning in. We'll be on the lookout for market developments worth watching. Catch the next episode of Sound Economies, Mel and Peter on the global financial markets, available on our website and on Spotify. For expert insights on the go, download the Lundin's Investor Insights app for free. Risk loving investors will find opportunities in our high quality alternative investment funds, especially our multi awarded Mutual China Fund. For more, visit lundinscapital.com.